Back in the trading room, everybody. I'm Shane Vernier, and this is FOMC Live. Today, we're going to go ahead and cover the latest installation of the United States Federal Reserve's, war on inflation or war on economic downturn. I think that you're in for an interesting treat here today. We're going to watch Jay Powell try to explain why the economy seems to be shrinking, and then we're also going to talk about, hey, what can the Fed do maybe to stimulate that? And they believe that it's a quarter-point rate cut. I don't know. I don't know what he's going to say. I think there's a lot of heat on the Fed. Since I said we've been off for about a week, so I'm a little bit rusty, just getting everything up and running. But I will say that since the last time we spoke, a lot has happened in the world. A lot has happened in the financial markets. And I think that we're going into a period of time which is absolutely unpredictable. It's absolutely unpredictable. Today, we're going to try to shed a little bit of light on what we think the Fed's going to do and potentially what we're going to be looking at for the U.S. dollar. In many ways, your guess is as good as mine. You know, I had an opportunity to travel a little bit, meet with some incredibly smart people, some people that really are juiced in and understand the markets and understand price and all the different things. And, you know, we had a great free flow exchange of ideas. And the question was, Shane, what do you think? What do you think? And I found myself saying, I don't know a lot. And that's like the one thing you're not supposed to do is I don't know. As traders, I don't know can be our biggest asset. So we want to make sure that if we don't know, we stay out, but we also want to have some pretty good ideas about what to do if things do go our way. So I do apologize. We're sort of running a little bit behind schedule today. A lot of it's because I just came off of I just rolled into the office today off of about a 25-hour trip back from Greece. Absolutely unbelievably long flights, but absolutely worth it, worth every penny. So good to see everybody back in the room. Marcus Stevens, knew you couldn't stay away from us on this day. Well, Marcus, I'm a little bit faded. I'm not going to lie to you. That's a long flight. The worst, probably the biggest stretch was from Frankfurt to Denver direct was about 10 hours. That's the longest flight I've ever been on in my life. Tyrone, buy or sell? Well, we're going to buy some things. We're going to sell some things. Jared Holden, welcome back, Shane. Absolutely, Jared, it's great to be here. It's always great to be back. I'm on about my 5th cup of coffee today and running a little bit behind. It's such a big day, though. I did want to cover this presser. I think it's really important. Sengoku, good to see you. Sengoku, welcome. Operator, you got this. Well, I'm going to see what I can do. We're going to see what we can do. Brian Barbie, hey there, Shane. Hey, Brian. If you guys have any questions at all on markets that you'd like to look at or just any basic questions, go ahead and fire them out there, and I'll be sure to look at them. We're going to look at the Euro USD right off the bat. We're coming up on 120. I think we could get there. We're printing 118.90 right now. I think that's a pretty interesting level. 120 looks to me like it's going to come into play. As far as gold, what do we think gold's going to do? Boy, we were calling for 4,000. We went right up to 37.50 and hit it. I think we're going to 4,000 relatively quickly, especially if the Fed comes out and they're dovish today, extra dovish. We got to see what Jerome Powell says. It's very, very important that we have an understanding of what the Fed is thinking before we start trading U.S. oil. U.S. oil holding at $64. Interesting. Is the dollar in that bad a shape? Yeah. 96.39 right now is the dollar index, off about 0.25%. That is sending crude oil higher. We have a few events that we need to cover today. The housing market looks to be taking off again. Mortgage applications are way up because everybody believes that we're going to see not just this interest rate cut, but a bunch of them. So let's go ahead and get started here. Adnan, good to see you. Yes, sir. Good to see you. Tyrone, let's roll. Emmanuel, good to see you. Tina, good to see you. Tina, welcome. Let's see. Lita, good to see you. Lita, always a pleasure. Steve Francis, hi. There's a big spike on the Euro USD. Do they know something that we don't? Yeah, the Fed just spoke. Bobby Bob, Tuku, welcome. Yeah, it was an interesting holiday, Steve. That's for sure. It was interesting. I got to see parts of the world I've never seen before, and that's always fascinating. All right, guys, let's go ahead and go. Right here, this was sort of the 920 crossover that we were looking at on the weekly time frame. We highlighted this a long time ago, but realistically, since last March, the Euro USD has been a buy. I mean, it's been an absolute bullish trend, 108.75, and then now we're printing about 118. That's what we call a banger trade. A lot of people want to talk smart money concepts. They want to say, okay, here's where the big money is. Forget all that. The big money is long. The big money is long, the Euro USD, and it's been long since March, since before the big tariff scare and all that jazz. So what we've got here is a nice big rally where we're trending towards 120. There's no question about it. So when we're looking at how can we trade it right now, I was going to put out a trade idea earlier today, basically to buy 118s on a pullback. There's no point even to put that out there, especially ahead of a Federal Reserve meeting. Something like this, though, 119.21, we're watching 118.20. If we get a pullback down to that zone, you really do have to consider buying it with reckless abandon. You want to be long this pair. You don't want to be short this pair. As far as the key level, 120 even. Fascinating stuff there up at 120. I love scalping in front of big round numbers. There's no question about it. 120 is a big round number in a huge magnitude for the Euro USD. So if you wanted to scalp right in front of that, I wouldn't mind it. Well, 119.94, something like that, 119.92, 119.89, maybe looking for 25 pips to the downside. Yeah, why not? I mean, we could definitely get involved there. Why would that trade potentially work? Because it's a key level. It's a long-term inflection point, an area of natural resistance, and we're just looking for a little bit of action. We're just looking for the buyers and the sellers to butt heads right there. If we take a bit of a short, we could definitely get a pullback easily, 25 to 50 pips. We're probably going to draw that one up later today, so be checking your email inbox for a fresh trade idea. That should be dropping. I want to see exactly what happens with Jay Powell, and then I want to let this thing settle down a bit, but that's sort of a fascinating level that you almost have to look at for the Euro USD. U.S. oil. U.S. oil, you can see I got this question earlier today. Weekly sell signal. We've been working the weekly sell for quite some time, but it just hasn't really developed the way that we thought. It just hasn't developed. I expected this to come down and really retest April's low. I said that before I hit the road, and now we're just seeing compression. So nice sell-off and sort of a retracement back to 65. I'm a net seller from 65. There's no question about it. The high this week is 64.76. We've got that, what is that, our 20 EMAs up there at 64.93. I want to be short right in front of 65 until proven otherwise. That's a big, big zone. As far as what we can look at our Fibonacci's, do we want to buy it or sell it? I'm not interested in buying it. Not even a little bit. I want to sell it, but we have to get good trade location. If we get good trade location, then we'll have an opportunity to make some money. And for me, 65 to the short probably is premium trade location for U.S. oil. Okay, here's gold. This is our pennant, our monthly pennant. You can see the compression and then the break, and we talked a lot about it, guys. I mean, we talked a lot about, hey, these big-time patterns on long time frames, when they finally break, they don't just go a little ways. They go a lot of ways. Take a look at what you've got cooking here for September. You're already up almost 7%. Almost 7%. That's unbelievable. That's unbelievable. So what we're thinking about is what should we be thinking of with regards to how to trade the gold market right now? I want to be long. I don't want to be short. I've been saying that for a long time. But over a flat summer and then a break, now we're starting to see it. There's some things that happened. I would say, in the last week, unless you guys have been living under a rock, you know exactly what I'm talking about, that suggests that there's going to be civil unrest in the United States at a large level. There's no question about it. There's no question in my mind what's going to happen here. I'll talk about that some other day. We're talking Fed today, but this right here, that's a pretty good 3-week rally. This last week, you're up 1%. Last week, you're up 1.5%. The week before, you're up 4%. This all speaks to dovish policy and civil unrest in the United States. 37.50, we had it outlined. We said, okay, quarter handle, likely going to be a nice inflection point. The high right there was 37.07. Still watching 37.50, potentially to the short. 4,000 will be our next stop. Really no question about that. In my mind, it's just a question of when do we get there. I like being more specific, but I would give myself probably until mid-January. I said mid-February early. It's going to happen sooner than that. It's going to be mid-January. That would be my guess. Let me see. Yes, sir, the old yen's falling out of bed. The markets don't seem to like the indecisiveness from Powell. This seems like they're already selling off from the hype. Joshua Chung, hello, Shane. Good to see you. PM says, good to see you, Dragon. Welcome back. Calvin, hi, Shane. All good. Good to see you, Calvin. Always welcome, guys. Okay, let's go ahead and do a quick sound check and see if I can find our J Powell, our little J Powell screen. I'm going to go ahead and get this going. We're going to do a sound check here, and I'm going to see if we can, in fact, get something going with regards to listening to this man talk. I don't know what's going to happen. You guys should be able to hear that, though, I would think. Sort of in and out. 2:30 p.m. It's going to be the man of the hour. Yeah, that's just the music. I don't know what the problem is there. Well, we'll see what he's got to say here. That's for sure. I don't know. I think it's going to be incredibly dovish, guys. Let me see. Adnan, gold is crazy, moving 3,000 pips in 3 weeks. Yeah, I mean, it really is one of those things that really, really hard to put our finger on why gold's up the way it is. It's up because you've got dovish policy. That's sort of that long-term, I don't know if I'd call it an ascending triangle, but it certainly just looks like a big bullish pennant to me. And we're having trouble with our feed, with our YouTube feed here on the Federal Reserve. So that does not surprise me whatsoever. Let's go ahead and hit the refresh, see if I can get this going. This is a big meeting, though. We want to see exactly what Powell's going to have to say. That's for sure. I'm not really sure what he's going to say. He's got a lot of questions to answer. And now we're buffering, so it looks to me like there's a problem with the feed. I don't believe it's my problem. I'm dialed up the correct way. We've done this before. Is the Fed offline now? Did they go offline before Jay comes out and gives his announcements? Now we're buffering. Unbelievable. Unbelievable. I mean, we could certainly work price action, but I want to see this. I want to see what he has to say. Okay, the Fed channel is still buffering. Does anybody else have it on YouTube? I do not see it working. In my portal, it is not working. So that's what we're looking at here. Unbelievable. This type of stuff has a way of really, really bothering me. All right, we're trying to reload now as we speak. Let's see if we can get this going. Still buffering. What are they going to control it? Plenty of live streams on YouTube. You can just check the other channels.
It reflects a slowdown in consumer spending.
Okay, now he's going.
In contrast, business investment in equipment and intangibles has picked up from last year's pace. Activity in the housing sector remains weak.
Should be able to hear it.
In our summary of economic projections, the median participant projects GDP to rise 1.6% this year and 1.8% next year, a touch stronger than projected in June. In the labor market, the unemployment rate edged up to 4.3% in August, but remains little changed over the past year at a relatively low level. Payroll job gains have slowed significantly to a pace of just 29,000 per month over the past 3 months. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and lower labor force participation. Even so, labor demand has softened, and the recent pace of job creation appears to be running below the break-even rate needed to hold the unemployment rate constant. In addition, wage growth has continued to moderate while still outpacing inflation. Overall, the marked slowing in both the supply of and demand for workers is unusual. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen. In our SEP, the median projection for the unemployment rate is 4.5% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal.
I'd say.
Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.7% over the 12 months ending in August, and that, excluding the volatile food and energy categories, core PCE prices rose 2.9%. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up, on balance, over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 3.0% this year and falls to 2.6% in 2026 and to 2.1% in 2027.
That's 2 years away.
Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 4 to 4.25%, and to continue reducing the size of our balance sheet. Changes to government policies continue to evolve, and their effects on the economy remain uncertain. Higher tariffs have begun to push up prices in some categories of goods, but their overall effects on economic activity and inflation remain to be seen. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. When our goals are in tension like this, our framework calls for us to balance both sides of our dual mandate. With downside risks to employment having increased, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance. With today's decision, we remain well positioned to respond in a timely way to potential economic developments. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario for the economy.
That's the dot plot right there.
The median participant projects that the appropriate level of the federal funds rate will be 3.6% at the end of this year, 3.4% at the end of 2026, and 3.1% at the end of 2027. This path is 1/4 percentage point lower than projected in June. As is always the case, these individual forecasts are subject to uncertainty, and they're not a committee plan or decision. Policy is not on a preset course. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored.
920
Our
crossover
success
on
in
the 5
delivering
minute for
on these
gold.
goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission, and we at the Fed will do everything we can to achieve our maximum employment
Everything
and
they
price
do,
stability
they do
goals.
for you.
Thank
They
you.
do
I look
for
forward
you,
to
everybody
our
at home.
discussion.
520, 920 crossover to the short.
Great.
RSI
Thank you.
confirmation.
Chris Regaver at Associated Press.
These are demo
As
dollars.
you know, Fed Governor Stephen Myron has continued, kept his position at the White House, even as he's joined the Fed
Absolutely,
board. This
Calvin.
is the first time, I believe, the Fed's board has had someone with executive branch ties in decades.
Wow.
Does this compromise the Fed's independence from day-to-day politics? And relatedly, how can you maintain the public's perception the Fed is politically independent with this dynamic? Thank you.
So we did welcome a new committee member today, as we always do, and the committee remains united in pursuing our dual mandate goals. We're strongly committed to maintaining our independence, and beyond that, I really don't have anything to share.
Yes, I'm not touching that one.
You and other Fed officials have spoken extensively about the impact of tariffs on inflation, although perhaps with many companies appearing to eat the tariffs, tariffs may be impacting the labor market and other parts of the economy instead. Do you see that as a possible outcome here, that tariffs are the reason we're seeing some slowing, particularly in the labor market, rather than in inflation?
You know, it's certainly possible. You know, we're beginning to see, we have begun to see goods prices showing through into higher inflation, and actually the increase in goods prices accounts for most of the increase in inflation, or perhaps all of the increase in inflation over the course of this year. Those are not very large effects at this point. And we do expect them to continue to build over the course of the rest of the year and into next year. And you know, it's also possible and that there may be effects on employment, but that I would say if you're looking at why employment is doing what it's doing, that's much more about the change in immigration. So the supply of workers has obviously come way down. There's very little growth, if any, in the supply of workers, and at the same time, demand for workers has also come down quite sharply. And to the point where we see what I've called a curious balance. It's, you know, typically when we say things are in balance, that sounds good, but in this case, the balance is because both supply and demand have come down quite sharply. Now demand coming down a little more sharply because we now see the unemployment rate edging up.
Nick Timmeros of the Wall Street Journal. Chair Powell, do economic conditions and the balance of risks no longer warrant a restrictive policy setting?
So I don't think we can say that. What we can say is this, that over the course of this year, we've kept our policy at a restrictive level, and people have different views, but a clearly restrictive level, I would say. So, and we were able to do that over the course of this year because the labor market was in very solid condition with strong job creation and all those things. I think if you go back to April and now look at the revised job creation numbers for May, June, July, and August, I can no longer say that. So what that means is that the risks were clearly tilted toward inflation. I would say they're moving toward equality. Maybe they're not quite out of equality. We don't need to know that, but we do know that they've moved meaningfully toward greater equality, the risks between the two goals, and that suggests that we should be moving in the direction of neutral, and that's what we did today.
Under what circumstances would a larger than 25 basis points rate cut be warranted, and how seriously was that option entertained at your meeting this week?
Good question.
There wasn't widespread support at all for a 50 basis point cut today. You know, I think we've done very large rate hikes and very large rate cuts in the last 5 years. And you tend to do those at a time when you feel that policy is out of place and needs to move quickly to a new place. That's not at all what I feel certainly now. I feel like our policy has been doing the right thing so far this year. I think we were right to wait and see how tariffs and inflation and the labor market evolved. I think we're now reacting to the much lower level of job creation and other evidence of softening in the labor market, and saying, well, those risks are maybe not fully balanced, but moving in the direction of balance now, and so that warrants a change in policy.
Interesting.
Colby Smith with the New York Times. Should we be viewing today's cut as the committee taking out some insurance against the possibility that the labor market is at risk of weakening, or is it the committee's view that the dynamics of a downturn are already in place? I guess I'm just trying to square the shift in the rate forecast in the SEP towards more cuts than just 3 months ago, with the fact that the forecast for unemployment didn't change.
Yeah, I think you could think of this in a way as a risk management cut, because if you look at the SEP, actually the projections for growth this year and next actually ticked up just a little bit, and inflation and unemployment didn't really move much. So what's different now? What's different now is that you see a very different picture of the risks to the labor market. You've seen we were looking at 150,000 jobs a month at the time of the last meeting. And now we see the revisions and we see the new numbers.
They're horrible.
I don't want to put too much emphasis on payroll job creation, but it's just one of the things that suggests that the labor market is really cooling off. And that tells you that it's time to take that into account in our policy.
Yeah, but they're only moving to neutral. They're not moving to
The
accommodate.
SEP, once again, the median participant has inflation higher than previously expected by the end of next year, and the Fed
They're in
not getting
trouble.
back to the 2% target until
This is
2028.
not a good situation.
So I guess I'm just wondering how you characterize the risk to price pressures of kicking off a series of cuts at this point.
Pretty good 5-minute
Yeah, so
trade, though.
I
on
would
gold.
look at it this way. We fully understand and
Start
appreciate
thinking about taking the money
that
if you
we
want
need
it.
to remain fully committed to restoring 2% inflation on a sustained basis, and we will do that. At the same time, we've got to weigh the risks to the two goals. And I would say since April, to me, the risks of higher and more persistent inflation have probably become a little less. And that's partly because the labor market has softened, GDP growth has slowed. So I would just
He's
say
got no
that-
answers,
that,
guys. They've
that the
painted
risks
themselves
there
into a
have been
corner,
less,
and it's not going to be pretty.
than one might think.
He's got no answers.
And in terms of the labor market, what we're seeing is unemployment is still low. It's still a relatively low rate, but we're seeing downside risks.
So you're looking at 36.50 right here. You got a spike
Michael
low at
McKee from Bloomberg
36.52.
Radio and Television. I'm a little
This is
confused
interesting.
by your explanation of the Fed cutting rates because of unemployment. If you think that most of what's happening in the employment
It's 'cause
area
what he's
is
saying doesn't
related
make any
to immigration,
sense. He doesn't
which
know what to say.
your rate cuts wouldn't address. How do you see that as more important than inflation, which has remained almost a full percentage point above your target?
Well, I was
always take the
saying
money.
that what's happening in the labor
Let's take
market
the
has
money.
more to do with
Go do something else.
immigration than it has to do with tariffs. That was the question I was answering. So I wouldn't say that all of what's happening in the labor market is due to tariffs. I mean,
That's
you
right. Here's
clearly
good
have
level.
a slowing in it due to immigration. You
Euro
clearly have a slowing
USD
in
118.20,
demand,
maybe
which is now perhaps
118.25.
more than that in supply, and we know that because the unemployment rate has ticked up. So that's what I meant by that.
He is disheveled
every
and off
year
balance,
since
guys.
2015, the SEP has forecast that you would hit your target 2 years later. And this year, this SEP says you're going to hit your target 2 years later. 2% does not seem to be in sight. Does that suggest that the 2% target is not really achievable? And does this present any credibility problems for you in telling people that
These
that's what
journalists
you're
are
going
on
to
him.
do? if
They're on
you
him
can
today.
never
He
reach it?
knows it.
Well, I mean, you're right. It does say we're going to get to 2% inflation in 2028 at the end of 28. But that's literally how you put the projections together. You're writing down a rate path, which is designed to create over the course of the SEP, time frame, 2% inflation and maximum employment too. So that's all that is. No one really knows where the economy will be in 3 years. But the nature of the exercise is to write down policy that you believe would return to the 2% goal over at least by the end of the
Man, he does not
exercise.
sound good. A lot of stuttering, worse than me today. Holy cow.
Thanks so much,
That's the
Melissa
idea.
Schulze with ABC News.
He's lame. This is his last one.
The latest inflation report shows that prices are still going up across key categories for many households, including groceries. What will the Fed do if prices pick up more?
These are hard
So our
questions.
expectation, and you can see this consistently through the year, has been that inflation will move up this year, but that basically because of the effects on goods prices from tariffs, but that those will turn out to be a one-time price increase as opposed to creating an inflationary process. That's been our forecast. Pretty much all the individual forecasts say that. We can't just assume that, though, right? We have to. Our job is literally to make sure that is what happens, and we will do that job.
Yeah.
Right now, the situation we're in is that we see inflation. We continue to expect it to move up, maybe not as high as we would have expected it to move up a few months ago. The pass through of the tariffs into inflation has been slower and smaller. The labor market has softened. So the case for there being a persistent inflation outbreak is less. And so that's why we think it's time for us really to acknowledge that the risks to the other mandate have grown and that we should move in the direction of neutral. So what will we do? We'll do what we need to do, but we have two mandates and we try to balance them. For a long time, our framework says that when our two goals are in tension, this is quite an unusual situation.
That's a nice dump.
How do we decide
gold.
what to do? Because our tools can't do two things at once. What we do is we ask which is farther from, how far is each from the goal and how long is it expected to get to the goal. So, and then we think about those things and we see, as I mentioned, our policy had been really skewed toward inflation for a long time, really. Now we see that there's downside risk clearly in the labor market, and so we're moving in the direction of more neutral policy.
Gosh.
Concerned are you about the slowdown in the jobs market for households at home, especially younger Americans struggling
nice
to land a
move.
job?
So it's an interesting
What's that on
labor
over the
market.
NASDAQ?
And obviously,
US 100.
we think it's appropriate that we reduce our rates so that we become more neutral, which
go to 1
presumably will be better for the labor market. You see people who are sort of more at the margins, so kids coming out of college and younger people, minorities are having a hard time finding jobs. The overall job finding rate is very, very low. However, the layoff rate is also very low. So you've got a low firing, low hiring environment, and the concern is that if you start to see layoffs,
Go to the dollar
the
CAD.
people who are laid off there won't be a lot of hiring going on. So that
Strong
can very quickly
resistance
flow
right
into
there. 137.88.
into higher unemployment. In a healthier economy, healthier labor market, there would be jobs for those people. But now the hiring rate is very, very low. So
Dollar
that's
yen.
been a growing concern over the last few months. And it's one of the reasons why we think it's appropriate that we begin to shift our policy focus toward a more balanced one.
Ask him why he cut interest
Steve
rates.
Leisman, CNBC. Mr. Chair, in the past, during rate cuts, you used the word recalibration. And I wonder if you pointedly did not use it this time. And in fact, when you said policy is not on a preset course,
See if we
did
can
you
find
mean
a buy on
that
this.
is sort of the opposite of recalibration? Are we meeting to meeting, data point by data point? Are we in the process here of getting back to neutral? Thank you.
So I think we're
Having technical issues. We're having technical issues with the YouTube channel. Bear with me here.
visual projections of 19 people showing what they believe at a particular moment in time
Should be
to
good.
be the most likely path for the economy and thus the appropriate path for monetary policy as well. And as you know, we don't debate or try to agree on what that is. We just write them down and accumulate them. We do sometimes discuss them. And so we always say we're not on a preset path, and we really mean that. The actual
bid.
decisions we make are going to be based on the incoming data, the evolving outlook, and the balance of risks at the time the decisions are actually made. So you will have seen that we have 10 participants out of 19 who wrote down 2 or more cuts for the remainder of the year.
I don't know what's going
and
on.
9
Yes,
who
sir.
wrote down fewer.
That's twice it's
than-
cut out.
In fact, in a good number of cases, no more cuts. So rather than looking at this as certainty, I would encourage people, as always, to look at the SEP as through the lens of probability. And so there are different possible outcomes and likelihoods rather than this one is certain and this one isn't happening. So that's what I would say.
Thank you for getting to my follow-up question, which was, is the dispersion
You can play
in
this
the
one really
outlook
tight.
a sign of uncertainty of policy in the meetings to come? Thank you.
Looks like the momentum's there.
It
For
is
the
such
dollar
an
yen.
unusual situation.
There's your crossover.
Ordinarily,
Boom.
when the labor market is weak, inflation is low. And when the labor market is really strong, that's when you got to be careful about inflation. So we have a situation where we have two-sided risk. And that means there's no risk-free path. And so it's quite a difficult situation for policymakers. And it's not at all
This is really
surprising
something.
to me that you have a range of views.
Euro
It's not
USD
so
bid
much
coming into
about
play.
having different views for the path of the economy, but it's partly that. But it's also partly about what's the right thing to do in light of the tension between
Watching
the two
that
goals. How do
closely.
you weight them? How worried are you about one versus the other? And so it's natural. I think it would actually be surprising if you didn't have a pretty wide range of views based, in this kind of highly unusual situation, and we do. So, but we
All right,
we
long
get
the
together,
Euro
we
USD
discuss,
from 118 and
we
a
have a
quarter.
great discussion, and then we decide what to do and
We'll
we
see how it
act.
goes.
But you're right, that it's a wide dispersion of views, and I think that's understandable and natural in the current situation.
Dollar's flexing right now.
Hi,
DXY
Victoria
is on the
Guido with
march.
Politico. You've talked a lot about Fed independence and the importance of it over the years, but as markets have questions about what exactly President Trump's intentions are with the Fed, what would you point to as the things they should be watching to determine that the Fed is still making decisions based on, the economic outlook rather than political considerations?
Look, it's deeply in our culture to do our work based on the incoming data and never consider anything else. That's just everybody who's at the Fed really feels strongly about that way. So, you'll know it by the way we talk about what we're doing, by the speeches that people give, by the decisions that we make. You'll know that we're just still going to do that. That's all we do. And we don't frame these questions at all or see them in terms of political outcomes. I think when you get to another part of Washington, everything is seen through the lens of, does it help or hurt this political party, this politician? That's the framework. And I think people find it hard to believe that that is not at all the way we think about things at the Fed.
Right.
We're taking a longer perspective. We're trying to, serve the American people as best we can. So I think you would be able to tell. I don't believe we'll ever get to that place. I would say we're doing our work exactly as we always have now, and people they're making their arguments, and we're having a great discussion around these challenging issues. So,
Do you see the court case around Lisa Cook as being related to questions of Fed independence?
I see it as a court case that it would be inappropriate for me to comment on.
We knew he wasn't touching that one with a 10-foot pole. We knew
Thanks,
that.
Mr. Chairman. Edward Lawrence from Fox Business. So we saw the preliminary benchmark revisions down 911,000. The revisions for June were the first negative revisions we've seen since December of 2020. How can the Fed base important decisions on rate and what to do with the interest rates on data that seems to be, as you've called it in the past, noisy?
It's a great question.
So on the QCEW, the revision that we saw was almost exactly what we expected. It was amazing how close the expectation was. So, and the reason for that is, for the last bunch of quarters, there's been almost a predictable overcount, and I think the Bureau of Labor Statistics really does understand this, and they're working hard to fix it. It's got to do, of course, it has something to do with low response rates, but it's also got to do with what's called the birth-death model. Because a good amount of job creation happens around new companies, and how many go out of business, how many are founded, and it's just really hard. You can't survey for that. You've got to have a model that predicts that, and it's quite difficult to do, especially when the economy is undergoing big changes. So, and they've been working on that and are making
Very
progress
strong
on
scalp
it. But
right there.
the data we get is still good enough for us to do our work.
That's a big level in the Euro USD.
To the extent we have
Big
issues
level.
around data right now, it's about low response rates. That's happened all over really. Response rates are just lower to surveys now, both in and out of the government. And it's no great secret. We want higher response rates, and we need those to have, less volatile data. And the way to get that is to make sure that the agencies that collect the data have sufficient resources to drive higher response rates. It's not a complicated problem, but that's what it takes. It's not a mystery. That's what it takes. The other thing I'll say, Edward,
Hey, Dennis.
is in the case of the job creation, the response rate is quite low for the first month, or lower for the first month. By the time you get to the second or third month, you're still collecting responses for that last month, for that prior month, and you get to
Remember,
the place
don't worry
where
about the
data
leverages.
are much more reliable by the second and certainly the third month. So it's not that
Strong
we don't
entry.
get the data; it's just that we get it a little
Nice,
later.
fast 10 pips.
For the
pretty good
benchmarks,
trade.
if that holds, it's
That's a
51%
fast
of the
one.
jobs that we thought were there weren't really there. Shows a weaker job market coming into this year. If you had had that information, would it have changed your mind related to where the interest rates should be? Should there have been a cut earlier?
We have to live life looking through the windshield rather than the rearview mirror, as you know. And all I can tell you is we see where we are now, and we
Jay.
take appropriate
Come
action.
on.
And we took that appropriate action today.
Thanks. Howard Schneider with Reuters. So, as you mentioned a minute ago, some margins of the job market would suggest that the slide's already happening. A black unemployment rate in August was above 7%, declining work week, difficulty among college graduates finding work, rising youth unemployment. Why do you think a quarter percentage point now is going to arrest that?
Well, I didn't say that I thought a quarter point would make a huge difference to the economy, but you've got to look at the whole path of rates, right? And the market's has already been baking in expectations. I mean, our market works through expectations, right? So I think our policy path really does matter. And I think it's important that we use our tools to support the labor market when we do see signs like that. I did mention that. You see minority
But you also said your
unemployment
path
going
was
up. You
neutral.
see
That's
younger
not a path.
people who are more
Your policy
vulnerable
path being neutral
economically,
is not a
more
path.
susceptible to
You're either
economic
restrictive or
cycles.
accommodative. That's
one
it.
of the reasons, in addition to just
He's talking in
overall
circles.
lower payroll job creation that shows you
Jane,
that
is
at
the dollar
margin,
strong or weak?
the
It's
labor
weak.
market is
It's
weakening.
showing
I would
strength
also
right
point
now,
to
but it's
labor
weak.
force participation. Some part of the significant decline
Sell
in
or buy
labor
the
force
dollar yen.
participation over the last
It's
year
tough. We're
has
long
probably
right here,
been
920
cyclical
crossover,
in
but
nature
we're playing
rather than
it
just the
tight.
usual aging process. So we put all those together, and we see that the labor market is softening, and we don't need it to soften anymore. Don't want it to. So we use our tools, and it starts with a 25 basis point rate cut, but the market's also pricing in a rate path. I'm not blessing what the market's doing at all. I'm just saying it's not just one action.
As a follow-up to that, the growth mix right now seems very concentrated in investment and on the consumer spending side in the higher income groups. Do you feel that that's an unsustainable mix for the economy moving forward?
I wouldn't say that. I mean, you're right. Those are two. We're getting unusually large amounts of economic activity through the AI build out and corporate investment. I don't know how long that will go on. No one does. In terms of spending, you saw that the consumer spending numbers were well above expectations, and that may well be skewed toward higher earning consumers. There's a lot of anecdotal evidence to suggest that. Nonetheless, it's spending. So I mean, I think the economy is moving along. Economic growth is going to be 1.5% or better this year, maybe a little better. Forecasts have been coming up, as you can see. So labor market unemployment is low, but downside risks, but it's still a low unemployment rate. So that's how we see it.
Hi, Stephanie Rule, MSNBC. Treasury Secretary Scott Bessent has said that the Federal Reserve suffers from mission creep and institutional bloat. He's now calling for an independent review. Would you support an independent review, or are you open to any sort of reform in any areas of the Fed?
Of course, I'm not going to comment on anything the Secretary says or really any other officer says. So in terms of reform at the Fed, we just went through a lengthy and I think very successful process of updating our monetary policy framework. I would say there's a lot of work going on behind the scenes around the assets we have in the Federal Reserve Federal Reserve system and at the board. Are they the right size? We're actually going through a 10% headcount reduction through the whole Fed, including the board and all the reserve banks. The employment at the Fed at the end of that will be basically at the same level it was more than 10 years ago. So we will have had zero job growth for more than a decade when we're finished with that, and I think we'll probably do more than that. So I think we're certainly open to constructive criticism and ways to do our jobs better.
But not an independent review?
We're certainly open to always trying to do better.
I mean, he's a beaten man. He doesn't know what to say.
Mr. Chairman,
he doesn't know what, these are hard questions. He knows there's no justification to cut rates other than the political pressure.
Labor market in terms of lower labor demand, higher productivity. By contrast, do you buy that? And if that is true, does that have implications for the monetary policy?
I'll answer your questions here in a second.
So there's great uncertainty around that. I think my view, which is also a bit of a guess but widely shared, I think, is that you are seeing some effects, but it's not the main thing driving it. And so particular focus on young people coming out of college and yeah, there may be something there. It may be that companies or other institutions that have been hiring
That's a
younger
pretty good
people
trade
out of
right there for
college
20
are
pips,
able
really
to
quick.
use AI more than they
Euro
had in the past.
USD.
That may be part of the story.
Beautiful level.
It's also part
Beautiful
of the story,
level.
though, that job creation more broadly has slowed down. The
Right
economy
there.
has slowed
I mean,
down.
that's a fantastic trade.
And so it's probably a number
Boom,
of things.
boom.
But yeah, it's probably a factor. Hard to say how big it is.
Love that trade. 38% on a daily time frame during a news event, right around a key number.
Thanks,
118
Mr. Chairman.
and a quarter.
What
I mean,
what
there's
evidence
not
do
much
you
not to
see
love there.
of
That's
tariffs
beautiful.
showing up in inflation?
Well, if you can take goods, just sort of the broad goods category, and
Dollar
last
yen
year
starting to correct. Dollar starting
goods
to flex.
inflation was negative.
Or
If you go
excuse me,
back
dollar starting to
25
slip.
years, that was the typical thing. Was that goods inflation was goods prices generally went down, even adjusting for quality. So that was not the case during the pandemic.
dollar
Of course,
CAD.
goods inflation went very high, but we had essentially returned to zero or slightly negative inflation. Now, I think goods inflation over the course of the past year is 1.2%,
Really
which
love
doesn't
that.
sound like a lot, but it's a big
137.88.
change. So we think, I mean, analysts have different views, but we think it's contributing, 0.3 or 0.4 or something like that to the current core PCE inflation reading, which is 2.9%. So it's contributing. What seems to be happening is that the tariffs are mostly not being paid by exporters, mostly being paid by really the companies that sit between the exporter and the consumer.
Let's go
So
the middleman.
if you buy something and you sell it through retail
The
or you use
businesses
it
are
to make
eating it.
product, you're probably taking a lot of those costs on and not able to pass it fully along to the consumer yet. That appears to be what we're seeing. All of those
Jay.
companies and entities in the middle,
Pressure
they'll
the
tell you
middleman.
that they have every intention of passing that through in time, but they're not doing that now. To the consumer, the pass-through has been pretty small. It's been slower and smaller than we thought. But the evidence it's very clear that there's some pass-through.
I also wanted to ask if you could share with us the conditions under which you might consider leaving the Fed in May.
I have nothing new on that for you today.
He's gone. Remember before he came in and said, listen,
Hi,
I'm going to finish out my term no matter what.
I just wanted to
gone.
follow up.
He feels like
on,
he's gone.
One of your answers just a couple minutes ago. We've often heard you talk about how you and your colleagues, do not think about politics.
that level
this
right
does
there.
not enter the room. But one of your new colleagues
scalp's
does come
not
from this
working.
world, right, where everything is seen through this framework of politics and of what party is being helped, and that person is still employed by the White House. How can markets and the public interpret, some of his speeches, for example, and then some of the forecasts that we see today? I mean, the median for this year was moved because of the introduction of his forecast. I'm talking about the number of rate cuts seen this year. What do you say to markets and the public that are trying to interpret, what you guys are saying?
So there's 12 vote, 19 participants of whom 12 vote, as you know, on a rotating basis. So no one voter, can really. The only way for any voter to really move things around is to be incredibly persuasive, and the only way
that
to
was
do
a
that
tell.
in the
Started scratching
context
his
in
shoulder.
which we work is to make really strong arguments
This guy's
based on
nervous.
the data and one's understanding of the economy. That's really all that matters. And that's how it's going to work. And I think that is the way the institution, if that's in the DNA of the institution, that's not going to change.
And then I wanted to ask about a Gallup poll that showed that Americans now have more confidence in the president than the Federal Reserve when it comes to doing what's right for the economy. Why do you think that is, and what's your response?
I have no
What's your
I have no
message to the
comment.
public?
Our response is we're going to do everything we can to use our tools to achieve the goals that Congress has given us, and we're not going to get distracted by anything. So I think that's what we're going to do. We're just going to keep doing our jobs.
Oh, God.
Claire Jones, Financial Times.
Given the range of views expressed prior to the meeting, I think there was a lot less dissent today than a lot of people expected. It'd be good to know just what you think the drivers were of coming to that very strong consensus in the meeting, and also on the flip side to just explain why the dot plots
poor man's
are
getting
really
dunked
so
on
scattered
hard.
between
Oh,
someone
they're
even
destroying him
expecting
today.
rates to
They're
end up
destroying
higher by
him.
the end of the year to 5 cuts. I mean, what were
He
the
needs
kind
to
of
wrap
range
it
of
up.
views you had about, on one side, why there was so much support for a cut today, and on the flip side, why there's so much divergence about what comes next?
So I think there's quite a wide assessment that the situation has changed with respect to the labor market. Whereas we could still say, and did say in July, at the time of the July meeting, that the labor market was in solid condition, and we could point to 150,000 jobs per month and many other things.
You can't do that now.
I think that the new data that we've had, and it's not just payrolls, it's other things as well, suggests that there really is meaningful downside risk. I said there was downside risk then, but I think that downside risk is now a reality, and there's clearly more downside risk. So I think that's broadly accepted. And so that meant different things for different people. Some wrote down, almost everyone wrote down, supported this cut.
Straight to dud right here.
Some supported more cuts and some didn't, as you will see from the dot plot. So that's just the way it is. I mean, people have, you have people who take this work very seriously, think about it all the time, do their work, discuss it with our colleagues. We endlessly discuss this between ourselves, and then we have a meeting where we put it all out on the table, and this is what you get. And you're right, there's a range of views in the dots, and I think that's, like I said,
this was fantastic.
very
This
unsurprising
USD.
given
Love
the
it.
quite unusual,
That was beautiful.
historically unusual nature of the challenges that we face. But let's remember though,
I mean,
the
that's
unemployment rate's
beautiful.
4.3%. The
Boom.
economy's growing at 1.5%. So it's
This
not a
doesn't
bad
look very
economy
good.
or anything like that. We've seen much more challenging economic times, but from a policy
Looks
standpoint,
like gold's reversed as well.
standpoint of what we're trying to accomplish, it's challenging to know what to do. There are, as I mentioned earlier, there are no risk-free paths now.
It's challenging to
It's
know
not
what to
incredibly
do.
obvious what to do. So we have
I
to
know what you're
keep
gonna
our
do.
eye
You're
on
gonna
inflation.
quit.
At the same time, we cannot
I'd
ignore.
quit. I'd
we must
get the
keep
hell
our
out
eye
of there.
on maximum employment, which is those are our two equal goals. And you will
Say
see
that
that
again.
there are a range of views on what to do. Nonetheless, we came together today at the meeting, and
This is one of the weakest
acted with a
press
high
conferences
degree
I've
of
ever
unity.
seen him give, and he's given some bad ones. This is a bad one.
Thank you, Archie Hall from The Economist. You mentioned earlier that job creation was running below your guess at its
Unreal.
break-even rate. I'd be curious to hear a bit more about that and where you think the break-even rate is.
So there are many different ways to calculate it, and none of them is perfect. But it's clearly come way down. You could say it's somewhere between 0 and 50,000, and you'd be right or wrong. I mean, there's just many different ways to do it. So wherever it was, 150,000, 200,000 a few months ago, it's come down quite significantly, and that's because a very lower amount of people are joining the labor force. The labor force really not growing much at this point, and that's a lot of where the supply of labor was coming from over the last 2 or 3 years. So we're not getting that now. We've got much lower demand. It's interesting that supply and demand have really come down together so far, except now we do have unemployment ticking up outside, just one tick outside of the range where it's been for a year. 4.3% is still a low level, but I think this level of this speedy decline in both supply and demand has certainly gotten everyone's attention.
Well, if I may, you mentioned the downside risk to employment a fair amount, but it's striking that measures of kind of activity and output for the third quarter, those that we have, seem pretty strong. The Atlanta Fed's GDP now is very strong. You mentioned strong PCE numbers as well. How do you square those things? Is there a chance actually could be upside risk to the labour market if those activity measures are right?
Well, that would be great. We'd love that to happen. So I don't know that you see a big tension there, but it's gratifying to see that economic activity is holding in. It's it's a good bit from consumption. It looks like consumption was stronger than expected. What we got earlier this week, I guess. But and also we're getting a fairly narrow sector is producing a lot of economic activity, which is the AI build out and business investment. So we watch all of it, and I would say we did move up. The median for growth for this year actually moved up in the SEP between the June and September SEPs. So, and really the inflation and labor market didn't change much. It's really the risks that we're seeing to the labor market that were the focus of today's decision.
Nicole. Hi, Nicole Goodkind with Barron's. Thank you for taking my question. Given the cumulative impact of high interest rates on the housing sector, I'm wondering how concerned you are that current rate levels are exacerbating housing affordability issues and potentially hindering household formation and wealth accumulation for a segment of the population?
God, another tough question.
Housing is an interest-sensitive activity, so it's at the very center of monetary policy. When the pandemic hit and we cut rates to zero, the housing companies were incredibly grateful, and it was really, they said that was the only thing that kept them going, was that we cut so aggressively and provided credit and things like that, and they were able to finance because we did that. The other side of that is when inflation gets high and we raise rates, and you're right, it does burden the housing industry, and so rates have come down a bit, and as that happens, we don't set mortgage rates, but our policy rate changes do tend to affect mortgage rates.
We don't set mortgage rates.
And that has been happening, and
That's
that'll of course raise demand.
Man, he wants to get out of there.
Lower
so
borrowing
bad.
rates for builders will help. Builders will help supply.
Tough meeting,
and so some of that should happen. I think most analysts think that it would have to be pretty big changes for it to matter a lot big changes in rates to matter a lot for the housing sector. And the other thing is by achieving maximum employment and price stability, that's a strong economy. That's a good economy for housing.
Okay.
And then the last thing I'll say is, there's a deeper problem here. There's not a cyclical problem that the Fed can address, and that just is a pretty much nationwide housing shortage. Or a lot of places in the country just don't have enough housing.
Tell them who's buying all the houses.
And all of the areas around metropolitan areas like Washington, for example, are very built up, and so you're having to build farther and farther out, and that's
not
where it
true.
is.
I mean, it is true.
And
but
just a
it's
quick
who's
follow-up.
buying all
During
the
the
supply?
last SEP, or the press conference following the last SEP, you seemed
BlackRock,
to indicate
State
that
Street,
policymakers lacked conviction
Vanguard.
about their projections, and I'm wondering if you still feel that way.
Forecasting is very difficult even in placid times, and as I've mentioned before, forecasters are a humble lot with much to be humble about. So I think right now is a particularly challenging time, even more uncertain than usual. And so I don't know any forecaster
Buying a lot of
really
homes,
ask
making them
any of
rentals.
the forecasters
That's
whether
where
they
the
have
supply issues are.
great confidence
No
in their
question.
forecast right now. I think they'll honestly
No
say
question.
no.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. If you're cutting rates, why continue to reduce the size of your balance sheet, then pause the unwinding?
Well, I think we're cutting the size of our balance sheet quite marginally now. As you know, with the balance sheet,
1 second, Sudoku.
we're still in an abundant reserves condition.
Good question.
And we've said that we would stop somewhat above somewhat above an ample reserves level. That's where we are, and we're getting closer to that. We're monitoring it very carefully. We don't think that has at all significant macroeconomic effects. These are pretty small numbers moving around inside a giant economy. The level of runoff is not very large, so I wouldn't attribute macroeconomic consequences to that at this point.
And at his recent confirmation hearing, Stephen Myron brought up that the Fed actually has 3 mandates from Congress, not just jobs and stable prices, but also moderate long-term interest rates. So what does Congress mean by moderate long-term interest rates? How should we understand that when we see the 10-year Treasury moving? And how do you think about this part of the mandate when policy choices like rate cuts or balance sheet reductions affect the long end of the yield curve?
So we always think of it as the dual mandate, maximum employment and price stability, for a long time, because we think moderate long-term interest rates are something that will result from stable inflation, low and stable inflation, and maximum employment. So we haven't thought about that for a very long time as a third mandate that requires independent action. So that's where that is. And there's no thought of, as far as I'm concerned, there's no thought of considering that, considering that we somehow incorporate that in as something in a different way.
Thanks, Chair Powell. Matt Egan from CNN. We recently learned that average FICO credit scores are down this year by 2 points, the most since 2009 during the Great Recession, and delinquencies are high for car loans, personal loans, credit cards. How concerned, if at all, are you about the health of consumer finances, and do you expect today's cut will help?
So, we're aware of that. I think this default rates have been kind of ticking up, and we do watch that. They're not at a level, I don't believe they're at a level where overall they're terribly concerning, but it is something that we watch. Lower rates should support economic activity. I don't know that one rate cut will have, a visible effect on that, but over time, a strong economy with a strong labor market is what we're aiming for, and stable prices. So that should help.
Just to follow up, this rate cut is coming at a time when the stock market is at or near all-time highs, and some valuation metrics are elevated historically. Is there a risk that cutting rates could overheat financial markets, potentially fueling a bubble?
Yes.
We're tightly focused on our goals, right? And our goals are maximum employment and price stability. And so we take the actions that we take with an eye on those goals. Separately, and that's why we did what we did today. Separately, we monitor financial stability very, very carefully, and I would say it's a mixed picture. But households are in good shape, banks are in good shape. Overall, households are still in good shape in the aggregate, and I know that people at the lower end of the income spectrum are under pressure, obviously. But from a financial stability perspective, we monitor that picture. We don't have a view that there's a right or wrong level of asset prices for any particular financial asset, but we monitor the whole picture, really looking for structural vulnerabilities, and I would say those are not elevated right now.
Okay.
Jean, we'll go to you for the last question.
Thank goodness.
Hi, Chair Powell. Jean Young with M&I Market News. I wanted to ask about inflation expectations. You've said the Fed can't take the stability of inflation expectations for granted. You mentioned at the short run they've gone up a little bit. I wonder if you can talk a bit about that. And then also at the long run, wondering, do you see evidence that the debate over Fed independence and the growing deficit is putting pressure on inflation expectations?
So as you said, shorter-term inflation expectations have tended to respond to near-term inflation. So if inflation goes up, inflation expectations will predict that it takes just a little while to get back down. Fortunately, throughout this period, longer-term inflation expectations both break even in the markets, and almost all of the longer-term surveys, Michigan being a bit of an outlier lately, have been just rock solid in terms of running at levels that are consistent with 2% inflation over time. So we don't take that for granted. We actually assume that our actions have a real effect on that, and that we need to continually show and also discuss our commitment to 2% inflation. And so you'll hear us doing that. We're, as I mentioned, it's a difficult situation because we have risks that are both affecting the labor market and inflation. Those are our two goals, and so we have to balance those two. When they're both at risk, we have to balance them, and that's really what we're trying to do. Your latter part of your question was about independence. I don't see
He goes, I'm not
market participants. I don't see that that's something they're factoring in right now in terms of setting interest rates. Thanks very much.
All right, that's a wrap. A couple of things. I want to answer some questions that we had in the live chat. I just didn't really want to talk over Jay Powell, and then I'll give you my final. Connecting, we're disconnecting, we're reconnecting. Okay, we're having technical issues all over the place, and that's fine, whatever. The bottom line is this, to answer your question, when I say that the dollar index, or excuse me, the United States dollar is weak, you ask me if it's strong or weak. Well, how come if it's weak, the dollar's going up right now? The bottom line is this, when you have a Federal Reserve chairman speak, it's going to impact short-term valuations. So when we look at something like the dollar is getting absolutely destroyed for 2025. Really, since Trump's inauguration, the dollar's absolutely crashed. So if we're looking at this chart saying, okay, what do I think about the aggregate market state of the United States dollar? It's weak. There's no question about it that it's weak. Absolutely none. Why did it bounce today? Could have been a number of reasons. Could have been just institutions getting involved. It could have been just traders, just basic price action after Jay Powell gave his announcement. That could basically be why. So when we see the dollar maybe bounce today, and right now you'll see that it's just barely above scratch on the daily time frame. It's important to understand that, we're still pretty weak though. We're still pretty weak. I mean, you can see just boom, boom, and then today we sort of put in that bottom, and then we rallied off that bottom. So the idea is that, okay, we're strong now. No, we're not. The dollar's been getting destroyed all year long, and it has to do with new economic policies. It has to do with policies of the Trump administration, and it has to do with interest rate cuts that are on the way. So to answer your question, why is it going up if the dollar is weak? It's just a function of short-term price action with a big-time news event. Remember, these big news events, these market drivers, you can't really correlate what happens right after somebody says something or anytime an economic number comes out. It's just a bunch of participation. It's the market, and it drives price up and down in a chaotic fashion. It's exactly what we saw here today. We saw it in gold, nice big sell-off in gold. This is a bullish thing for gold. The rate cuts are a bullish thing for gold, but we still saw a bit of a sell-off here. This right here came back down. If you look at the short time frames of what we had on the 5-minute chart, I mean, there it was. There was sort of rallies, faked everybody out, then we rallied, then bang, we sold off, and now we're rallying. There's just chaos in there right now, and then that has to do with the economic event. Let me see right here. We had one other question. Son Goku, don't you guys have social governmental housing in the United States? There is some government housing. They call it, I think it's Section 8 housing or something like that. I don't remember the exact name, but yeah, there are projects, government projects in housing. It's debatable. The expansion. Here's the deal. I mean, a lot of times there was just areas that were government housing. That's the bottom line was, and they would say it's low income housing, but there's more iterations to that. It's more complex than that now. A lot of folks at the county level and at the local levels are trying to build those types of projects to get the government injections of capital and also satisfy the housing shortage. So to answer your question, yes, there are complete government projects that are housing in one respect, but there's also partial where the government is giving private developers stipends to build houses, not necessarily single-family dwellings, but multifamily dwellings, if that makes any sense. So to answer your question, it's sort of complex. A lot of people believe at the local level, a lot of the local politicians want those types of projects because there is money coming in from the federal government. So answer you there. Little buffering. Yeah, I mean, I don't know what's going on with the tech here. It's always the first day back. Something happens. I probably have to just update my software or something. I didn't have time today. Let me see. Son Goku, in the Netherlands, it's standard to have those to keep corps from buying them, and it could be. It could be. I mean, what's happening here in the United States as far as housing goes is that we all pretty much know. It's like Calvin said in the live chat. What we have is institutions like BlackRock, State Street, Vanguard. It's being said that by 2030, these institutions are going to own 65% of the single-family dwellings in the United States. Now, what that means is if you're a huge hedge fund worth billions and billions and billions, and you have unlimited capital, and you're buying these single-family homes sort of in the name of having a rental portfolio or whatever you want to call it, that's going to be a problem. And I was in the real estate business a long time. I was in housing. I've been really trying to handicap and break down what's happening with this market right now, the housing market, and I can say that it's not a real market. The money's coming in from somewhere, and what happens is BlackRock buys these homes. The prices stay artificially high. There's no question about it. That is the demand, but it's not true demand. It's not like I want to go buy a house, or you want to go buy a house, Son Goku, or Jane wants to buy a house, or Calvin does. It's not all of us saying, okay, well, I want this one, I want this one, I want this one. It's BlackRock saying, okay, I'm going to buy them all. And then you guys can maybe deal with me, or deal with us to do some sort of lease agreement or whatever. Let's take a look at our interest rate expectation and what happened during Jay Powell's talk. This is for the October meeting, and you'll see that October we're anticipating another rate cut. Will we get it? I don't know. December 10th. What are we thinking about there? 83% says you're going to get running rate cuts and leave the party in 2025 right around 3.5 to 3.75%. A couple of things that I would say before we sort of sign off here. If you want to trade any of these ideas or any of the trade ideas that we had or strategies that we have out there, be sure to check out Switch Markets. Switch Markets is sort of a broker that gives you a huge service suite, and you're going to see a lot on Switch Markets, a lot of webinars and things. We got the webinar dropping soon. I will relay the information as soon as that's coming out. I believe it's going to be coming out probably tomorrow, I think. But as soon as that hits the wires, I will tell you exactly where to find it. As far as, we had all these things. News of the day was definitely the FOMC, but you can take a look at this 30-year mortgage rate. It's coming way down. Look at the mortgage applications, spiked 29.7%. That's up big. People are starting to apply for mortgages again now that you're seeing the 30-year mortgage rate down a little bit from where it was above 7. And that BOC cut interest rates today by a quarter point. That's fine. Crude oil inventories came in at an absolute dreadful negative 9.2 million barrels. That's an astounding loss for this time of year and suggests that maybe bullish between the rate cuts and lagging supply. I would say that you're probably going to see crude oil hang around that $60 mark even as we drive deeper into the fall. It's tough. These are tough markets to read. Let's see. Calvin Shane, I read BlackRock bought a house for $300,000 and sold it to themselves for $700,000. A shell company to run up the value, pricing out others. That sounds about right, Calvin. Think about it. I mean, if you're running shell companies, we all know they do it. I mean, in trading, we call them dark pools of capital, where the dark pools are actually providing liquidity to the markets. In something like real estate, what's a dark pool? It's just a shell corporation of a giant hedge fund. So in one respect, think of the benefits. Think of the net benefits to that, though. BlackRock can turn around if they bought for $3 and sold it to $700 to themselves. They can mark to market those projects as a profit and actually impact their bottom line. And then on the other end, if you're buying at $700 and you are the shell company, what are you really anticipating doing? Nothing. You're going to keep it. You're going to rent it, or maybe they're going to burn it down. I don't know. I can tell you that that's exactly what's happening in this market, though, and it's not a real market. So I'm sorry, the housing market is not real. All right, let's see. Steve Francis, do you still see 120 for the Euro USD? And can somebody press the fire alarm so Jay can do a runner? Yeah, no kidding, right? Let's see. 120, yeah, I 100% do. I think that the U.S. dollar is going to keep getting lambasted, no question about it. This trade's still alive, this dollar yen. I think it's a dead duck for right this minute, but we might end up winning. As far as 5 minute right here, Euro USD, you can see there was a sell signal. Bigger picture, though, let's get back over to sort of our macros for our Euro USD. If I'm looking at the euro dollar, I'm saying a couple of things. Number one, you sort of had this long-term uptrend that's just really goes back to what we saw in February, and the whole year has just been the dollar getting destroyed. So you've got that nice rally, then compression break. All right, so you've got 120. Does it go to 120 from here? Well, I would say probably yes. And this will be the trade idea more than likely out later today. If you want a quick preview of this, it's going to be a basic Fibonacci play. Spike low right there, back on the 25th of August. And then what do you got right there? Excuse me, the weekly chart. And you got a spike high that's set up this week. It's not quite a spike. It's just an upper extreme, but you see what I'm saying. 117.87. You want to be long this market. The only thing is, can you buy it right here? No, not really. We're going to chop sideways more than likely for a while. 117.87 though, fantastic zone. We had the 118.25 buy that we executed during the live stream. That was a winner. The gold sell was a winner. This dollar yen trade still hanging on. It's not banged out just yet. This is one of those that I would want to be long. I would want to be long the euro US dollar because we know the rate cuts are coming and we know there's something else happening here in the United States. And I'm going to talk about that in just a second. It's not a very happy subject, but we have to really price it in and figure out what's going to happen if certain things transpire. We heard a lot today about a jobs market that's terrible all of a sudden. Sort of what Jay Powell was saying. He goes, well, we thought we had a decent jobs market. Well, we don't. Okay. So what does that mean? It means recession. means recession's coming. So we're going to talk about it in a second. Nico, I missed you. I missed you guys too, Nico. I do apologize, though. I am a little bit flat today. Usually I bring a lot more heat, but that was a long plane ride. that was a long plane ride, guys. Let me see. You mentioned social unrest earlier in the stream. What did you mean? Is it the Charlie Kirk moment? 100%. That's exactly what it is. Let's go ahead and just talk about this briefly and what it can do to the markets. I had just left. I had left the country, and I remember landing in Greece, and I was just checked into the hotel and was just exhausted and was waiting just to go to sleep. And then I heard the news break, and I said, "Wow, that's a tremendous thing," and sort of put it on the back burner and went about my business overseas. And when I came home, I took a look at what's been transpiring, and some of the things I've heard in the media today are unbelievable. They're unbelievable. There's people that are saying a lot of things on both sides. In my opinion, this just started something very, very serious here in the United States. No question about it. I don't really care what anybody thinks about any side at this point. I can tell you that once political violence starts, if we know anything from history, guys, once political violence starts, it does not stop. It does not stop. And what typically ensues is a situation where there's a long period of unrest. Tempers right now are hot. The United States is a hornet's nest. Most folks are just waiting for the next shoe to drop. In my opinion, that's one of the reasons why gold is trading where it's at. People don't know what's going to happen here. You say, Shane, okay, political unrest, how can that impact the markets? In theory, it wouldn't impact the markets. It would just be sort of tit for tat, infighting between different sects. The problem is you're going to see destabilization and a fresh uncertainty injected into the security of the United States. Now, once that happens, then we're going to see very bold things. You're already seeing bold things happen, but you're going to start seeing more and more bold things that are going to transpire. And the question will become the foreign direct investiture that really has flown in under the Trump administration that they're so proud of, the FDI, the money coming in from other countries to build up this thing here in the United States and all the investment. That investment's going to begin to stop, especially if the unrest is as bad as it really could get. When that happens, you'll see an economic slowdown, and you're already seeing the beginning of the economic slowdown. Jay Powell, in my view, that was the worst press conference. He looks like a defeated man. Now, in the other ones, he would be sort of engaging, and he'd say, well, we're doing this, and this. He looks to me like he already made the decision to quit. No question. I'm sticking by my guns. I don't believe that he's going to be around till the end of the year. I think his term's coming up next year, and he can serve through May, I believe. But I believe he's gone. I think he's gone. And I think right now he sees the handwriting on the wall, and it's time to get out. Now, as far as what that could do, that's just another shakeup. That's more uncertainty. Pair that with civil unrest. What do you have? You got a real problem here. You got a bunch of questions that nobody has an answer for. And anytime you get uncertainty, what happens? Safe havens go up. Hard to argue. Look at gold. Gold's at what? 36.64. I think it goes to 4,000. Silver's printing 41.62. Dollar yen, where's that at? 146.61. You might see more action in the yen. Those are traditional safe havens. Dollar Swissy, we didn't even look at that. Dollar Swissy potentially could go even lower. Right now trading 78.77. It's up about a quarter today. But still, the Swiss franc has dominated the U.S. dollar this year. So the uncertainty that I'm talking about is really what we call systemic risk in the markets. Systemic risk is when the whole thing collapses. What would be the catalyst behind a major market meltdown here in the United States? Civil unrest would be a big part of that. And if we started to see more violence, political violence, it'll turn real dark real fast, and it already has. The repercussions from what happened last week in the Charlie Kirk situation are unpredictable. I don't care what anybody says. I'm not a political commentator, but I know markets, and I can tell you right now that it's unpredictable. What happens now? The Pandora's box has been opened, and man, once the violence starts, it's really hard to stop. Take a look at all of them. Take a look at all the situations of the past 40 years. Where the political violence has begun and how bad it gets and how long it takes to stop. we're in uncharted waters, and it's wildly unpredictable right now. That's why safe havens are up. What happens to the U.S. dollar? We already know what the Trump administration's planning to do for the U.S. dollar. They're gonna try to devalue it to boost the value of the exports abroad, and then also to kickstart economic growth at all costs. Doesn't matter if they're ready to not worry about inflation. I mean, did you hear the dot plot and the inflation expectations? We're talking about not getting down to that 2% goal until 2027. They don't know where the heck they don't know where the economy is going to be in 2027, and that's where this unrest thing comes in. If that injects enough uncertainty, all these projections don't mean a damn thing. So what I saw today was a very humbled Jay Powell, and what I see in the future is a very uncertain future with regards to basic economic growth. You know, I was calling for a pullback, a recession earlier this year. We didn't get it. Do we believe it's going to happen now? I think so. I think the jobs numbers are really bad, and the inflation is going to go nowhere but up after this rate cut. My own opinion. Let me see. Sengoku, UK and European anti-immigration sentiment and widespread unrest is going to spur something 100%. Also, Russia is probing EU defenses with the drones flying over Poland. Yeah, I mean, as soon as my plane landed in Frankfurt, Germany, I was watching the news and I couldn't believe what I was seeing. They said the BBC was reporting it was the biggest act since World War II. Drones in Poland. These types of things are, listen, an EU-Russia war, a widespread war, a full-scale war, that's not a recession, that's a depression. That's what that is. The United States devolving into sectarian violence. Think of what happened in Ireland back in the day between the IRA and Ireland. I mean, as soon as that happens, there's no putting the rabbit back in the hat. It takes forever to stop that stuff. Forever. So I know that the markets are at all-time highs. And like I said, I'll talk a little bit more about my trip and some of the folks and some of the conversations we had. I had a chance to talk to some folks that are pretty good traders that have been in the markets a long time. And, you know, the big question for me was, Shane, is the top in? Where's the top at? Is the top in? And I go, man, I don't know. Theoretically, interest rate cuts are going to send your stocks to all-time highs and drive equities market growth. Should have sent Bitcoin higher today. Starting to get a little bit of a rally there, but Bitcoin's down. So there's a lot going on here. The sentiment, the tone in that room, I just watched the media absolutely attack Jay Powell. And they asked him a bunch of questions that he didn't have answers for. And that's hard. That's uncertainty. Jay had a tough day. All right, guys, I've gone on way too long. I mean, we're over an hour right now. I do apologize for the technical difficulties, but it just seems to be the way of it. Anytime there's a layoff, you come back and you got to calibrate everything. And today I rolled in, just got into the office this morning. Flights got delayed last night. No excuses here, but definitely the last 36 hours I've covered over 6,000 miles. So a little bit tired, but we'll be back tomorrow. I'm going to have the full schedule up for the rest of the week on the How to Trade website. Remember, if you have any questions at all, swing by, send me a private message. I'll do my best to get back to you in short order. I think that we did okay. We caught that washout in the gold market. As far as what's going on, I really love that Euro USD. It was an absolute beautiful scalp in a trade. And then right now we've got that dollar yen play sort of making a comeback right down to back scratch. So I love where our stop loss location was. This one we elected to play very tight beneath that price bar, beneath our entry bar, because putting the stop loss way down here is way too big of a risk, about 100 and something pips. We're not going to do that. So we played it tight. We're starting to get a little bit of a bump. Could this trade still win? It's got a long ways to go. It's got to go up another 70 pips. You might get it maybe after the Tokyo Open if it's not stopped out, but I wouldn't mess around. If this one reverses against you, take the loss and move on. Very delicate situation here today. Very delicate situation. Let me see, Calvin. Trump asked the Supreme Court to give him total control over the U.S. economy. It's not a good idea. Not a good idea. Lita, thanks so much, Shane. You're absolutely welcome, Lita. The Supreme Court to give him total control over the U.S. economy. What would that look like? He's going to cut interest rates down to nothing and try to spend his way out of the mess. inflate away the debt, make sure that everybody has jobs and money coming in. And as long as the spending continues, then the idea is that growth continues. Doesn't work that way. Then you end up in a situation like Japan's in, where there's a lot of debt in Japan. What are they, 250% of GDP? Long term, will it work? But that's pretty much what I see happening out of the Trump administration. They want to grow their way out of the problem. They believe there's a financial catastrophe that's coming, and the only way to do it is to cut interest rates down to nothing and try to get out of the mess. But I think that it goes back to COVID, guys. When they went 0%, shut the world down, went unlimited quantitative easing, it opened up a can of worms that's a lot like the violence we're talking about. Hey, you say whatever you want. I mean, when they went on unlimited QE in 2020, they're talking about not being able to get back down to 2% inflation by 2027. They fundamentally changed the financial system. Fundamentally. When you start having political violence where one side shoots the leaders on the other side, you have fundamentally changed the equation. It has gone from some sort of discourse, even a heated discourse, to a war. And as soon as once wars kick off, they don't stop. Russia, Ukraine should have shown us that. If you had asked anybody 2 years ago if they believed that, or 3 years ago, 4 years ago now, however long it's been, that the Russia-Ukraine situation would still be going, they would have called you a liar. They said, this will be settled really quick. Once wars start, they don't stop. Domestically or internationally. That's the way of it. Go back and take a look study some history. Once those things start, they don't stop. And I would be very concerned right now with our markets. I'm very concerned with them. I could see a major pullback despite whatever's tried, but is the wealth going to be real if they cut the interest rates to zero? Probably not. Let me see. Callie, thank you, Shane. Great to see you again. Great to see you, too. Callie, Bobby Bob, thank you. Okay, guys, I've wound on way too long. I think everybody's got other things to do. But I do appreciate everybody showing up. Remember, that schedule will be up and rolling for the rest of the week in the How to Trade Trading Room, and we will be back here across all our YouTube channels, Forex Signals TV, How to Trade, and also on Switch Markets. We just dropped a new video on Switch Markets TV. That's where our content is going to be showing up more and more and more, and you're going to go ahead and see that one. If you haven't already checked it out, go over to Switch Markets on YouTube. It's a very small channel. We've got about 600 something followers there, but we will be putting videos there. And we put one out on uranium. If you're interested in uranium, go give it a look. And you can always follow me at ShaneV_Trader on X. And that's about a wrap, guys. If you have any questions at all, be sure to cruise by and ask me. And we'll go ahead and get back after it, guys. Have a fantastic trading session. Trade the action well. We'll see you tomorrow. All right.